This past year was also one of unprecedented complexity, obfuscation, and scandal. These are symptoms of the final days of an economic system. There was a successful prosecution of a countrywide interest rate rigging scandal that affected all 50 states, known as the municipal bond scandal, or more specifically, the United States of America versus Carrello, Goldberg, and Grimm. Then there was even a larger interest rate scandal, one that affected the entire world. Prosecutions in the LIBOR scandal, which was uncovered in July 2012, have already begun. Last year, banks paid $10.7 billion in fines for such transgressions. White-collar corruption has never been so apparent, yet regulators seem to be no more interested in bringing this to the public's attention than are the compliant media. Despite the blatant flaunting of the law during the subprime crisis, no major player has gone to jail or even been prosecuted. MF Global's robbery of money from its client's account in broad daylight not only went unprosecuted, but in January 2013, a judge nixed customers' attempts to depose MF Global's infamous CEO, John Corzine. Mr. Corzine, of course, is the former head of Goldman Sachs and a former senator and then governor of New Jersey. He is also a major fundraiser for President Obama. Wall Street alumni continue to make their way into political positions as the relationship between Wall Street and Washington becomes even more intimate. With the fox guarding the henhouse, there's little chance of this trend changing course. With an endless stream of green shoot reports coming out of the mainstream financial media, gold continues to climb a wall of worry. This means that gold is still far from its exponential phase when people start lining up for miles to buy gold, as they did in 1980. And despite temporary healthy interruptions to its price ascent. However, many are still asking what will cause the price of gold to stop going up. Some mention the U.S. resurgence after the much ballyhooed shale oil fracking program that releases natural gas from shale and is supposed to make the U.S. energy independent. The U.S. did increase domestic oil production by 766,000 barrels per day during 2012, which resulted in the highest domestic production in 15 years. Foreign oil now supports just 41% of American demand, down from 60% 7 years ago. However, fracking is a dangerous and expensive practice that is unpopular with environmentalists and primarily provides natural gas, which cannot be stored as oil is stored. It will also require decades of infrastructure development. U.S. debt problems are systemic, and as the recent fiscal cliff stalemate indicated, the country may not have decades or even years to right its economic ship. Negative real interest rates would have to turn positive. Yet for every 1% increase in interest rates, the United States would have to add approximately $160 billion to its federal debt, as index pensions and other inflation-sensitive obligation would become much more expensive, as would borrowing to meet these costs. Rising interest rates in this environment will be almost impossible due to the massive amount of global debt. In 1981, when Fed Chief Paul Volcker raised interest rates to as high as 21.5%, with official inflation at 7.5%, it stopped the flow of currency into gold. This could never happen today, as the United States owes far too much debt to make high interest rates viable. A deep recession in countries like India and China that are major gold buyers could negatively impact the price of gold. However, history shows that such harsh economic conditions in countries that believe so strongly in gold may have the opposite effect and cause even more capital to flee to the protection of gold. People become even more serious about wealth preservation in times of crisis. Little short of discovering how to make gold from salt water will change the primary direction of gold, which for the coming years is upward and on its way to $10,000 an ounce and beyond. This year, 2013, will likely be a more positive year for gold than 2012, if history is a reliable indicator. Over the past decade, since gold began to regain its stature as money, U.S. election years have been lackluster for gold, and the following year has shown a significant rise in price. Currently, it takes very little for short-term optimism about gold to turn bearish. This is a further indication that gold has much further to rise. Each time a hedge fund or a government intervention causes a precipitous drop, such as we saw twice in December, gold sentiment becomes weaker. Mark Holbert of Gold Newsletter Sentiment Index had this to say about negative sentiment towards gold. Of the last 3 decades has shown that at the 95% confidence level that statisticians often use to assess whether a pattern is most likely genuine, gold tends to do better in the wake of low levels of bullish sentiment, like now, than in the wake of excitement and enthusiasm. This past year showed a strong negative bias amongst most sentiment indicators, such as the Holbert survey and market vein. This is a strong contrarian signal for the coming year. Over the next decade, the golden debt chart shows the projection of U.S. debt, assuming gold will continue the same close relationship with debt as demonstrated in the historical gold and debt chart discussed earlier. Now, gold's price is directly proportional to the massive amount of debt that is being created to keep the current fiat system alive. This will likely continue until a crisis, such as a severe global recession or hyperinflation, strikes one of the major developed economies. Either event will be bullish for the gold price, but for different reasons. The price is being driven by the physical market in the developing countries such as India and China. China has to continue buying as much physical gold as possible if they expect to eventually compete for the world's reserve currency status. Some estimates state that the Chinese hope to have at least 10,000 tons to outrank their main competitor for gold, the United States. In 2012, gold mine production was approximately 2,700 tons, of which India and China bought nearly 2,000 tons between them. For the past 5 years, emerging markets accounted for 70% of gold demand. The question of who actually owns the United States gold is debatable and made particularly opaque by complex, highly secretive gold lease arrangements. The increased calls for gold repatriation and for audits of Fort Knox and the U.S. Federal Reserve could shed light on this issue in the coming years. This is the perfect time to hold gold and silver for wealth protection. Fund redemptions, negative institutional sentiment, financial repression, and the raging currency war will ensure gold will continue its climb to 10,000 an ounce. I expect that gold will end 2013 between $1,900 and $2,000 an ounce, and silver between $40 and $45 an ounce. In a world where financial and geopolitical certainty is evaporating, no one knows what Black Swan event could cause the explosion in the gold price. Some have suggested it will be a failure of a major bank, or derivative exposure, or a Middle East war. A major downgrade of U.S. bonds might also be the catalyst. In 2013, as been the case since 2001, the best policy for wealth protection remains to simply buy and hold uncompromised physical bullion until we are once again on solid economic footing. Thank you.